Are you ready to take advantage of investment opportunities even as home prices continue to drop? The housing market is constantly evolving, and the recent decline has left many investors feeling uneasy. To successfully navigate this downturn, it's important to analyze crucial indicators like the Case-Shiller index and compare the current state of the market to pre-pandemic conditions. While the drop in prices can be alarming, it's important to keep a balanced perspective and remember that market fluctuations are a normal part of the economic cycle. By staying up to date and adopting a long-term strategy, investors can overcome the challenges of a housing market and leverage potential investment opportunities during this ongoing decline. So if you're seeking to make informed decisions during this period of falling home prices, stick around to learn valuable insights and discover potential investment prospects. Although it may seem like good or bad news depending on your perspective, credible evidence suggests a different narrative regarding the decline in home prices. It's essential to understand that decreases in housing prices are quite uncommon. In fact, since 1987, there have only been 3 instances where home prices dropped for 6 consecutive months. The first instance occurring during the early 1990s in the lesser-known housing crash, while the second instance happened in 2008, which marked the most severe real estate downturn since the Great Depression. A crucial concept that many homebuyers might not comprehend is the speed at which the real estate market changes, whether it's rising or falling. It's important to acknowledge that things don't unfold as they always do in the movies. During the previous crash that took place nearly 15 years ago, the collapse occurred over a span of years, not days or months. The Case-Shiller Home Index price reached its peak in July 2006 and then experienced a 32-month consecutive drop before stabilizing into a fluctuating pattern until February 2012. By that point, 5 years and 7 months had elapsed since the beginning of the downturn. This entire crash was a slow and drawn-out disaster. To put this into perspective, think back to where you were 5 years and 7 months ago, which would be around August 2017. Imagine housing prices steadily decreasing during that entire period. Despite the lengthy duration of declining values in 2008, the median price of an American home has only dropped by approximately 27%. So, why is this information important? It is mainly to establish expectations. If 2008 was the most devastating housing crash in modern American history, what should we reasonably anticipate going forward? On this channel, I've discussed various indicators suggesting that this trend might persist in the near future. However, where will home prices ultimately end up? To investigate this, I developed my own graph using FAT data to compare the 2008 downturn with the current situation. I examined 3 years before each peak and set the peak at 100. Consequently, the 2008 peak appears at this point, and the 2023 peak appears at this other point. What's crucial to understand about this chart is that it demonstrates that the current situation is worse than it was in 2008. That's not an overstatement. Focusing on the peak, we can see that during the 6 months following July 2006, when the previous crash began, there was a decline of around 1.1%. Comparatively, today, we are down by 4.4%. This suggests that if we are indeed at the beginning of a new crash, we are starting at a level 4 times worse than the previous one. Observe the 2023 line in relation to the 2006 line. Considering the relatively short amount of time that has passed since the peak, we have never experienced a national real estate market quite like this one. The rate of this decline is unparalleled, and even though it might seem insignificant from a historical standpoint, it is record-breaking. It's important to understand some key points about the Case-Shiller index in order to grasp the current state of the housing market. First, the index is a lagging indicator, which means it doesn't necessarily show the immediate, real-time situation in the housing market. Instead, it calculates a 3-month average based on previous data. For instance, the December report we're currently discussing actually reflects the sales of homes during October, November, and December of the previous year. Furthermore, the data from October could even include closing prices for homes sold in August. This is significant because it was in late August when we saw a dramatic increase in interest rates. Between August 4th and November 10th, the average 30-year rate in the United States rose from 4.99% to 7.08%. This sudden spike put a considerable strain on the housing market, likely contributing to the decline in prices during that time. However, following November 10th, interest rates eased somewhat, and with the brief surge in the new year, it is possible that housing prices may have improved in January. Therefore, the next Case-Shiller report could break the trend of declining prices, but it doesn't alter the overall downward trajectory. Previously, low inventory levels were thought to prevent housing prices from dropping, but recent trends have challenged this belief. The Bill McBride chart, which compares national inventory levels to changes in housing prices throughout history, provides valuable insight into this phenomenon. Historically, prices have not decreased until inventory reaches 6 months of supply. However, 2022 has proven this assumption incorrect, as prices have fallen even with the inventory levels at nearly 3 months of supply. This deviation from the usual pattern suggests that a significant inventory isn't necessarily required for housing prices to decline. If this trend continues, we could witness a record-breaking drop in prices. The critical question, though, is how low housing prices could actually go. To put this in perspective, consider the worst housing market crash in recent history, the 2008 crash, which saw a peak-to-trough decline of 27%. If we take a hypothetical $400,000 house price as an example and assume a similar crash occurs with a 22% price decline, which is 5% less than the 2008 crash, the house's value would decrease to approximately $309,000. However, it's important to manage expectations because even if a housing price experiences a significant drop, affordability may not improve as much as hoped. This is because external factors such as interest rates and overall market conditions will also influence the true cost of purchasing a home. To put it simply, there's an essential factor often overlooked when discussing home prices: interest rates. You see, approximately 75% of homes are purchased with a mortgage. Now, back to the subject of mortgages. As I mentioned earlier, the majority of home buyers rely on mortgages, which means that the total price of a house is only part of the story. In reality, most Americans should pay closer attention to their monthly payments, as these payments are what truly determine how much they're willing to sacrifice to live in a particular home. During 2020, home affordability reached near record lows. The average monthly payment for an American buying a house was approximately $1,200. Since then, the average payment has skyrocketed to $2,486, more than double the 2020 figure. Although home prices have increased by 38% in the same period, monthly payments have risen by a staggering 100%. Predicting future interest rates is nearly impossible, but considering current inflation data, it's highly improbable that we'll see rates drop below 5% for a 30-year mortgage anytime soon. At the moment, the 30-year rate is above 7%, and even if rates were to decrease to that level, it would necessitate a historic crash to bring monthly payments in line with 2020 figures. By most estimates, this would require a more than 35% drop from the peak price in July, surpassing the severity of the 2008 financial crisis. The Federal Reserve's excessive money printing in recent years has dramatically altered our understanding of prices, including those of real estate. We're likely in the midst of a prolonged crash that will see property values continue to decline. However, it's doubtful that monthly payments will ever return to the pre-2020 levels. The Federal Reserve has inadvertently created a stark divide between those who purchased homes before the dramatic rate increase and those who didn't. This division between the haves and have-nots has been exacerbated by the central bank's actions. As Michael Antonelli highlights on Twitter, a Goldman Sachs chart revealed that 99% of outstanding mortgages have interest rates below the current level, with most borrowers locked into 30-year agreements and rates between 2% and 3%. The full implications of this situation remain unclear, but it's evident that it poses a serious threat to the social fabric. From a supply perspective, it's reasonable to assume that few homeowners will be willing to sell their properties when faced with a mortgage nearly twice the size of their current one. Consequently, existing home sales may remain sluggish for the next few years, with only those who absolutely must move choosing to do so. If you've enjoyed this video, guys, make sure to subscribe to the channel, like